Thanks everyone for taking the time to join us today. So I'll kick off my presentation. Just looking at the agenda for today. So start off with the executive summary. We'll highlight the key thesis around the auto space and why we think there's opportunity there. And we look at the fundamentals, and then we follow off to the valuation. So I think there's some of these auto OEMs are trading at a discount and offer opportunity now. And we'll talk around our recommendation and how we think about valuing these companies and the upside. And then we close off things with our final remarks and just on the company specific elements and just why we like these companies and the investment thesis around them. So just to highlight how we see things now, we'll start off with the outlook. If you look at the volumes of the auto OEMs currently, they're still at about 20% from 2018, 2019 levels. That's pre-pandemic. And they're still there. And the reason that volumes haven't recovered now as we move out of COVID has been the key issue that Vaughan touched on, semiconductor issues. So this has curbed the volumes in this space. And when we look at the IHS vehicle production estimates for 2021, they're still flat. And you only start to see recovery in 2022 when you gradually see a 5% increase. And it's only at the end of 2023 where they'll reach the 2018, 2019 levels. And really the key issue here affecting the demand has been semiconductors. So that's limiting supply, but the demand is high as reflected in order backlogs. And this creates a good formula for a favorable pricing. And that's the key element here. So you're seeing strong pricing that's really driven by the high demand, but limited supply. And really that's just pushing pricing. And then that's why we sort of like the sector. So we're seeing as you move out of COVID, there'll be a rebound in volumes within the space that's good pricing and a high demand. And then in terms of the balance sheet, these companies are cyclical in general, but across the board, they're sitting on a net cash position, which makes the balance sheet very robust. So it's companies that are trading at a discount with very, very appreciated brands and offer upside from the current share prices. There's still a risk that we see, and the key one has been the transition to electric vehicles. And there's also been governance issues. So we've seen quite a lot about the Dieselgate and antitrust, but we've seen that there's been change of management around these companies, and that's why we still think that they do offer values despite the risk. So the three companies we're looking at today is Volkswagen, BMW, and Daimler. All three companies are very, very strong brand, and with Volkswagen and Daimler, most of the earnings really come from their automotive business, and the gray bars that's the financial business. So that's a bit smaller in the mix, and a bit of commercial vehicles as well. So that's what we see with Daimler and Volkswagen. And then in between, we see BMW. So half of it is automotive and the other half is financial services. And we think there's quite a good opportunity for a rebound within Volkswagen and Daimler as you start to see a rebound in the automotive demand. So what has happened is that within the financial arm of the part of the business, it has been very defensive in this time. We'll unpack that. So we think the opportunity really lies when there's automotive demand recovery in volumes. So this next slide sort of speaks to that. On the left, you see the passenger cars, light commercial vehicles. And then on the right, you see the commercial vehicle production numbers. And pretty much what this chart just says is that these guys have taken a knock and pretty much have taken a knock as we moved towards COVID. And our thesis going forward is that as you see recovery, you see a lot of earnings growth, and that should then help improve the share price increases. And now, the segment which these vehicles operate in is within the premium segment. So as you see, the premium segment has been tracking faster than the global passenger cars. That's the black dotted line. And now, the reason behind that is that there's quite a lot of demand. You generally see quite a lot of demand as you go through, and we think that demand will continue to persist as we come through. So on the commercial vehicles, they took quite a huge knock, and the reason behind that is that there's been prioritizing the high premium luxury vehicles. So that's why, and the reason they prioritizing this is because of the semiconductor shortages. So that's another opportunity as semiconductors start to normalize and you see a little bit more volumes there. You'll see the recovery as well in volumes. I mean, as I highlighted earlier on, IHS is sort of forecasting a flat to slightly positive numbers. And what the OEMs have seen that within the premium segment, it's grown around about 12%. That's in 2021. And then in 2022, IHS looks at vehicle production numbers growing by 5%, 2023, around about 8%. That's when you gradually start to move closer to the pre-pandemic levels. And as sort of one touch to, generally, the sector sits within the consumer discretionary. And generally within the consumer discretionary, as you see interest rates increases, it generally has an adverse effect on the sector as a whole. But within the automotive, and especially where we're looking at now, BMW, Volkswagen, and Daimler, we think there's opportunity there as they play within the premium segment. So within the premium segment, it's generally more resilient as the customer base there is very wealthy and generally is not as well as affected by interest rate hikes. So what this chart sort of looks at is a correlation between the US 10-year and the various OEMs. And as we see that there's positive correlation over time. So as generally interest rate increases, we sort of generally expecting share prices as well to sort of move more or less in that direction. So the correlation is just around about just below 0.6. So we do think the premium segment within automotive as a whole is generally more resilient than the whole consumer discretionary. So it does offer some opportunity, a pocket of growth. And the next chart sort of just speaks to the earnings margins over time. I mean, if you just look across the chart, you see that it generally is cyclical and it always shows quite a lot of resilience in terms of bouncing back. And as we sort of lean our estimates towards consensus, as I look at those dotted lines, you're pretty much seeing a recovery in 2021, but the recovery overshoots a bit. And really this has to do with these guys that have over-provisioned on the financial services business, and as they reverse these provisions, they're seeing abnormal earnings, which is a little bit artificial, and so we think that will start to normalize a little bit lower, and the margins will rebound back definitely from where they were in 2020, and we've seen the signs of this. And as I mentioned earlier on, that pricing is something that we're seeing in that formula where they've got high order backlogs, limited supply, which is creating a favorable pricing environment. And this chart sort of looks at the financial services business. So what you see, the line charts reflect the return on equity, which is on the right axis, and then the bar charts is your credit loss ratio. So I'll start off with the credit loss ratios, which is on the left side of the axis. And if you just look across time, you see that the credit loss ratios have been coming down. This just speaks to that the risk or the clientele that they're taking in is less risky. It's less risky clients, and they're being conservative about who they bring in. And as you move to 2020, you generally would see those credit loss ratios overshooting. But what you've seen is quite a lot of resilience within this business. And the ROEs as well, they've been quite resilient. And this sort of speaks to the premium segment being very resilient over time and still generating good ROEs. But the trend has been on a slight decline. This has been a function of tighter regulations over time and also reinvestments. But we think that the ROEs are definitely at healthy levels, and the credit loss ratios are definitely healthy levels as well. And so when we value this business, so we look at the credit loss ratios and we look at the ROEs and we sort of infer the price to book. And this is sort of what the table below sort of communicates. So with BMW has the highest ROE, followed by Daimler, then Volkswagen. The company with the highest credit loss ratio is Volkswagen, and then we see Daimler and BMW sort of tracking lower. So, I mean, given the dynamics of the ROE, the credit loss ratio, we sort of infer the price to book. So because BMW is much more resilient than the rest of the players, we give it a high price to book. And because Daimler, then Volkswagen has been a little bit more risky and a little bit lower ROE than the peers, we give it a lower price to book, and sort of Daimler sits in between. So that's how we sort of think about the valuation of these businesses. That's pertaining to the financial services part of the business. I mean, as I mentioned, the biggest risk within the sector has been the transition to electric vehicles. So these guys have really struggled sort of moving ICE, internal combustion engines, to electric vehicles, and there's been quite a lot of push by regulators as well. And going forward, so they've had to invest quite a lot in research and development. So, I mean, the region that's setting the pace in terms of EU regulation has been Europe. So by 2050, they don't want to see any internal combustion engines on the road, so the ICE vehicles. And so that's by 2050, they expect full decarbonization. And so they say that given that a vehicle more or less has about a 10-year lifespan, by 2040, that's when they expect the last ICE vehicle to be produced. And they accelerated this even further and saying by 2030, the guys have to stop producing vehicles. So that's how the regulations sort of think about it, and that's Europe. So you can see that's the blue line there. And by 2030, you're pretty much seeing zero production of ICE vehicles, and that's taken quite a lot of pressure on auto OEMs just around the world, as Japan has started to follow as well. So JP Morgan estimates that by 2035, you'll see no ICEs coming in from Japan as well. And the gray line is China as well. That's also pushing around 2035 as well. So this is much faster than the whole world, as that's the black dotted line. And the guys, which is a US and Korea, they're sort of behind the curve. So they actually pushing it further. So this just speaks to the risk, because if we've seen the regulators aren't shy to impose penalties. So that's a big overhang on the sector. And the European OEMs have put in quite a lot of investment behind this. And as you see, research and development as a percentage of sales has been growing. And as they finish off this cycle of investments, we expect this massive investments to gradually start coming down, and this will have a positive effect on the margins. So these companies are gradually starting to come down with the R&D expenditure. I mean, just to summarize what we've discussed on. So we think when you look at the first row, which looks at the EBIT margin, we think there's a lot of room for a mean reversion. So when you look at a VW, for instance, the margins are currently at 3.3%, and the historical average is around 5%. Something similar with Daimler as well. And BMW is currently trading at a premium now, as this has really been driven by the financial services business, and they've been investing much more significantly with compared to the other peers. And just one thing I'd like to point out is when you go straight down to capex as a percentage of sales, so it's investment, you'll see that the European peers, so that BMW, Daimler, and VW, have really accelerated the investment. So they're not investing as much as the Asian peers, because they're still behind the curve. And you see that the capex as a percentage of sales is about 20%, 13% for Honda and Toyota respectively. And you can see that they have to play catch up, whilst the European OEMs are a bit ahead of the curve. And just looking at the valuation, so the first one we look at is a price to earnings 1 year forward. And we think at these levels, it's still quite low. but not significantly low, but we'll compare it with the other peers and you'll see it, they do actually screen out well. But we think there is room for opportunity. Yes, they're still trading relatively slightly lower than historical average. We see a slightly similar trend, but with the price to book, where price to book was quite elevated at the start of the decade and gradually is coming down. But we see it now again. It started to positively pick up, and it's slightly higher than what we've seen with the height of the pandemic, but it's still below 1x for BMW and Volkswagen, and it's slightly at 1x for a Mercedes. So this slide just speaks to that. ROEs have recovered to where they were before the pandemic started. And so how does this compare to the other peers? So we see that on a price to earnings basis, so this table sort of paints it out a little bit better on what you've seen in the charts. You see that the European OEMs are trading at a discount as you just look across. It's on the price to earnings basis. BMW is about 26% discount, Daimler about 24%, and Volkswagen about 14%. And then GM Motors and Ford are trading at a premium. And then the Asian peers as well, Honda at a discount, and Toyota at slightly flat. When you look at the price to book, it's a similar relationship that's being communicated, but the discount on the price to book is not as significant as you see in the price to earnings. And then when you look at the return on assets, they're actually generating return on assets, which is in line or slightly ahead with the group average. So that's what you see when you look at the BMW and the Daimler. And when you shift towards Volkswagen, but while the Asian peers, they're still experiencing quite a bit of a drag from having to invest a lot, especially when you look at a Honda. And General Motors and Ford, I guess they do justify their premiums to a certain extent. And you see a similar relationship when you look at the ROE as well. And I'd just like to point out in the last one is that they're all sitting in a net cash position. So the balance sheet is actually quite strong across the board. And so when we go about thinking about the valuations of these companies, so as we mentioned, it's high premium brands that some of these companies own, so such as a Porsche, Mercedes, or BMW. So when we think about the margins and when we value them, so we value the companies on the sum of the parts basis. So for every brand, we apply the applicable price to earnings multiple and as the brands, or when you move across the board and you look at the premium brands, they have high margins and you apply a higher multiple. So that's what you see with the Porsche. That's on the one end of the spectrum, and the other end of the spectrum, where it's less premium, more volume based, it's Volkswagen, and that has a lower margin and you apply a lower multiple to it. So the higher the brand, it's more profitable. We apply a higher multiple, and the more on the volume based, like Volkswagen, which is less profitable, we apply a lower multiple to it. And it's a little bit of a business slide, and then to summarize our valuations for the companies. So according to our valuations and the way we think about it, considering both risk and return, we have a buy on Daimler, we have a buy on Volkswagen, and we're neutral on BMW. So when we think about valuing these companies, so we looked at in the previous slide, we talked about the multiple in the brand, and there's also a risk that's inherent within these companies. And so to reflect the higher risk, we apply a higher discount rate, as you see on the bottom, and also it's affected by the multiple. So the multiples that we apply to a BMW is about 5x, and then this is considering the rebound level, the recovery in volumes, and we think there's high opportunity within BMW, and we think within Daimler as well, there's quite a lot of opportunity going to Volkswagen. So that's ideally how we think about the opportunity. So we reflect the prospects through the multiples, and then to sort of highlight the risk as well. So we're looking at the bull case, which is on the brew, the probabilities on the brew, and the bear case. probabilities in the red. But what we pretty much say is that we think Volkswagen has a higher risk, so hence we have a higher probability on the bear case, and we also think there's a higher prospects as well. So that's why we apply a slightly higher probability as well than the peers. And pretty much we see value in BMW, we see value across the board, but our buy cases on Daimler and Volkswagen is offer about 16% and 24% upside respectively. And so this is ideally how we thought about valuation. And the other element that we sort of see is that when we value these companies, so when we value these companies and we look at the various intrinsic values, is that we notice that for Volkswagen in particular, Von pointed out earlier on, is that about 58% of the pension liability, so they've got about 40 billion in the pension liability that sits on their balance sheet. That's your defined benefit plan. And then we look at that defined benefits of 40 billion, about 3 billion for BMW and about 5 billion. So as a percentage of the company's intrinsic value and which we value the company, it's quite significant for Volkswagen, which is about 58%, and about 5 and 6% for the other two players. So looking at that, it's about since it's quite significant, and as Vaughan pointed out, the one key assumption there is that as we're moving into an interest rate hike cycle, that interest rate becomes important, because as they discount this interest rate, as they use that interest rate to discount, there's future benefits to today. So if interest rates increases, then that means the value of the pension liability sort of decreases. And we look at the various sensitivities and the impact it might have on the company's fair value. I mean, not to get into too much detail, but the idea is that if for a 50 basis point increase in interest rates, we see the value of the company increase about 7%. And for a 1% increase in the interest rates, we see about a 15% increase. I mean, the sensitivity analysis is maybe a little bit too lenient, as you have to look at the pension liability element and the pension assets element as well. So as mentioned earlier on, there might be, you will have about bonds and you will have equities as well, which generally when interest rates increases, you would have a bit of an adverse effect as well. But we think overall, you would generally see a decrease in the pension liability as interest rates increases, which offer additional blue sky to what we've seen earlier on in the upsides on our valuation. So we do think this does sit in the base case, but really it's but we don't include it. But we do think it's something very meaningful that we look out for. So just to conclude and highlight our investment summary, probably quite a lot I've touched on that. I think Volkswagen offer the greatest opportunity given this valuation. And really, it's quite a benefit from volume recovery like the other players do. But we think it also has a strong potential for margin recovery as well. And then the pension exposure as well offers blue sky. So we do see quite a significant upside on Volkswagen. And on Daimler as well, we see about significant upside, about 16%. And then really the key driver there is that they're monetizing the premium brands. And they also had listed their truck business. And that has quite a lot of opportunity as well. Not only does it benefit from a volume recovery, as we saw it took quite a knock, it also has a cost restructuring plan and margin improvement. We're a bit neutral. We're neutral on BMW, although it does offer upside. We think because of its high exposure to the financial services, coming out of a crisis, we prefer to be like a more automotive exposure. And as the volume starts to recover, they benefit more, because we expect now with more automotives, no one's going to pay as much of a premium to the second-hand car sales, which was benefiting the financial services. So that's why we think there's more opportunity for Daimler and the Volkswagen. And as mentioned, the transition towards to electric vehicles does still remain quite a risk in the sector. That concludes my presentation. Thank you very much for listening.